Hi, my name is Shreyans, and today we are going to do a basic financial analysis of a company that has been instrumental in the growth of industries in India. We might not realize that, but the company has provided the fuel that all the industries need in order to grow. But before we start, it is very important to understand that this is not investment advice. We're just trying to understand the financial performance and position of the company. And the company that I'm talking about is an extremely important PSU company, Coal India, right? Coal has been the primary source of fuel, the primary source of energy for a lot of things that run around, right? So, and if you look at the website of Coal India, it will tell you that it is the single largest producer of coal, not in India, but in the world. So that is a very, very big thing, right? All right, so let's start with the financials of the company. And also, one thing that I would like to suggest at the start is that this is going to be slightly difficult to understand because there are a lot of different things happening with the financials and the performance. So this might also be a good learning experience if you're trying to understand how varied the performance of the company can be, or how to make sense of things that are going in different directions. All right, so let's get started. So if you look at revenue, then it started with around 59,000 crores, right? In it went up decently till this point, but after this, there was a sudden decline and then a recovery and then again a decline. So this is a sort of inconsistent thing, so to say, because if you look at the growth rates, where decent growth rates in some years, again, 2 years of decent growth, 2 years of weak growth, 2 years of again decent growth, then degrowth, and so that is why it's slightly inconsistent. And the same sort of thing can be noticed with EBIT as well. So EBIT peaked out here, right? Revenue peaked out in the last 10 years. Revenue peaked out in FY17. EBIT peaked out in FY13, right? And if we remove the last 2 years, and the PAT peaked out here, and then the EBIT and PAT fell suddenly here in these 2 years, right? So from 14,700 crores to only 8,800 crores. So there's a fall of 40% in EBIT and 35% in PAT, right? And then again, there is a 35% or 36% and 24% fall. And then they have suddenly increased, right? This is almost from 5,600 to 21,000 crores, and from 7,000 to 17,000 crores, right? And then they both of them have fallen slightly. So this is slightly difficult to understand, right? So you could probably still say that the starting 6 years from FY11 to FY16, you could make some sense of it, but in FY17 to FY20, things are very difficult to understand that what's really happening, right? Because in the year that the revenue was its maximum, the EBIT and PAT were at its second minimum, right? And then again there was a poorer year, and this is something that we'll have to look to understand, that what has driven this sort of volatility, or driven this sort of inconsistent performance between even the revenue and EBIT and PAT. Okay. Now looking at cash flow, I mean, cash flow is understandably more volatile. The thing to understand here is that the total cash flow from operations is more or less very similar to the profit after tax, right? So I mean, it's 1,37,000 crores a year and 1,36,000 crores a year. So not a lot of difference, to be honest. Uh, the interesting thing here is that CFO is greater than PAT in only 4 years, but cumulatively there are equivalent. So I mean, this is something that due to the operational cycles and volatility in working capital items, due to which CFO can be more volatile than PAT. Now, with CFI and CFF, there are a couple of things that would be very interesting to understand, to be honest. Now, if you look at CFI at the surface level, the cash flow from investing activities, then the figures look very inconsistent. There are smaller figures, I mean, positives, small positives, large negative, small inflows, large outflows, and things like that, right? But we'll have to dig deep to understand what's really happening here. So the company's non-current assets, if you look at here, have consistently increased, right? So the company is consistently reinvesting into its business, right? But a lot of that is actually also cancelled out by the investment income that the company is generating. So the company has made a lot of investments. It receives interest income on that, and maybe some trading. It does some trading as well, trading of investments, and due to which it is able to generate large inflows as well, right? So the company is able to generate large inflows. The company is investing as well, and the net figures comes out to be, very volatile, or we can't really make a lot of sense of it. So that is why it is important to understand the breakdown of cash flow from investments. With cash flow from financing, what you will see is there are consistent large outflows. These are not even small numbers. For example, it's 7,000 crores here, 25,000 crores here, 19,000, 17,000. So if you look at here in 1, 2, 3, 4, 5, 6, 7, in 7 out of the 10 years, it has been more than 10,000 crores. And most of them are actually dividends, right? So, I mean, this is something that you can expect from a large PSU company, right? It's one of the largest PSU companies to pay a lot of dividends to the government because government is a major shareholder, right? So the company has been consistently paying dividends, right? And as a result of that, what you look at here in equity is that equity peaked out here in 48 at 48,500 crores or something like that, right? And then it has been falling, and then it fell down to the minimum of 20,179 cr, and then it has again increased, right? So the book value of equity is very much in line with where it was 10 years ago. So in FY11 it was 33,300 crores. Now it is just 1,000 crores less than that, right? Because the company has been paying a large part of what it is earning as dividends, right? So that is why not a lot of the earnings are getting retained or getting added to the equity base. With current assets, the important thing to understand here with current assets here is that the figures are quite large, understandably so, but the company has flush with cash, right? So if you look at the breakdown of the current assets, a large part of this, right, anywhere between 15 to 20%, up to 20%, it would actually be cash, right? Inventories is something that you naturally expect the company to maintain, and I was expecting actually the inventory to be the largest current asset, but I figured that cash was the largest current asset that the company has. So that was quite interesting, right? Non-current assets, as it is understandable, the company has been making continuous investments. It has, when it started, it was obviously not that big a producer of coal, but now it's the largest single coal producer in the world, right? So that is something that you can't get without investing continuously into assets, right? Now, if you look at current liabilities, the current liabilities have more or less been in line with the revenue, so to speak. It's been increasing, decreasing. There've been highs and lows, right? So this is something that we'll have to understand at what's going on here. There are trade payables. There are mostly other items of current liabilities as well. The non-current liabilities. Now, this is where it also gets very interesting because what you'd see here is that non-current liabilities have gone up by 2.6x, gone up to 2.6x, right? From almost 25,000 crores to 65,600 crores. And what you would assume at the start is that most of these are borrowings, but they are not. Most of these are actually provisions, right? And that was something very interesting to understand, that the company has very, very high provisions. And this is something we have to understand, that why the company has made provisions, or what is the provisioning policy, right? Because on one hand, we have equity whose book value has, I mean, fluctuated, but it's still at similar levels. On the other hand, we have non-current liabilities which have increased to such a large extent, right? And that is something that we'll have to understand, that what's really happening here, right? So we've also talked a little bit about the growth rates of the different financials with revenue, EBIT, and PAT. As you can see, it's been quite inconsistent. With equity, it went down 4, 5 years consistently in a row, and now it's again back up. With CFO, you can understand the volatility. With assets, they've broadly gone up, right? I mean, these are current assets and non-current assets as well. Non-current assets have gone up year after year for all the years, and current assets, there's been slight volatility. All right. And if we look at the different liabilities as well, liabilities have broadly gone up. A large part of liabilities are actually provisions. Within current liabilities, there are slight bit of short-term borrowing, but the major liability item that I figured was the provisioning that the company has done. All right. Now coming into the metrics, which are going to be quite interesting as well. So if you look at the company is generating pretty solid returns on capital, right? The return on capital has been greater than 15% in most of the years except for these 2 years. So the lowest is 7.9%, the max is 26.2, but the median is 18.8, which looks pretty solid, right? Now, if we talk about return on equity, then return on equity is even better than the return on capital, right? The minimum is 32.6%, which is very, very high. And this is not even something that you'd find even in private companies, right? The maximum is 66%, but that's an anomaly. That's not something that you'd usually see. The median is 36.2%. That's again a very, very good figure. So let's try to understand that how is a PSU company trying to is able to generate such high returns on capital. Right. So as we know that there are two parts of the returns on capital, which one is the margin, the other is asset utilization. So if we look at the margins in these years, the margins are still around a bit of range, but then these fell, and in these 3 years, it was probably around the lowest. And in the recent 2 years, the EBIT margins have actually been around the highest. In this year, it was the highest. PAT margins have still not gone up to that point, but they have also drastically improved, right? So as I was saying, these 4 years is something that's very unusual. Maybe these 2 years, it was probably due to some operational changes or whatever went around in the company, due to which, these margins flat out compressed. But then again, it has, bounced back up very sharply. And this is something we need to understand, that what's going around here and if these margins are actually making sense or not, right? If you look at the other component of return on capital, which is the asset utilization, then you'd figure out that it's more or less been, around a specific range. So it's actually been going around in that places. It was improving, but again, in these 3 years, it was not the best, right? So, but broadly, the capital turnover and even the asset turnover as well, if you notice, it was improving, but in the recent 3 years it was not so great, right? Because of the performance of, because of the decline in revenue. But broadly speaking, the company has been able to have it has been able to maintain its asset utilization, even as the scale is increasing more and more for an already very large company. But really the secret, or really the driver behind such high ROEs, actually return on equities, is the leverage position. So if you look at, since the company is paying out most of its earnings, a lot of its earnings is dividends, right? I mean, so the equity base actually stays intact, whereas the liability base is increasing. And as a result of that, the asset by equity, which is the financial leverage, is going up year after year, right? And it reached the highest year, and then it has fallen for a couple of years, right? So this is it is magnifying the return, whatever the return the company is generating, because of the leverage position, the return gets magnified, and that is why you see the so high ROEs, because PAT margins have been volatile or inconsistent, and asset utilization has been maintained, but because of the leverage position, those returns on equity are being driven the most, right? As we talked about the cash flow versus PAT position in 4 years, 1 year, 1 year, 1 year, and another year, which was 300%, right? So in these years, I mean, the cash flow has been greater than PAT, but broadly overall, the cumulative CFO is slightly above the cumulative PAT. And if you look at the net cash flow position, then obviously it is understandable. In some years it was inflows, in some years it was outflows, because the company is continuously reinvesting into assets. It is also getting investment income. It is continuously paying out dividends as well. Then there are so many changes that go around with the working capital as well. So due to which you can understand that the net cash flow position is quite volatile. Current assets less current liabilities. So this is trying to understand the working capital of the company, and it also somewhat it has been performing in line with revenue, slightly more volatile than revenue, obviously, because there are lots of components that are driving the change. But majorly, I would feel that it has been performing in line with revenue. With non-current liabilities to equity, it has consistently increasing. But thing to understand here is that most of the non-current liabilities are provisions, and the company has been paying out a lot of a high amount of dividends, which is why the equity base has not increased as it should, right? So these were the different metrics, and let's try to quickly wrap up with the highlights, right? So decent revenue growth and limited EBIT and PAT growth, right? So if you look at EBIT and PAT, they went from 11,000 up to a max of 15 here in these 4 5 years. So in the initial 6 years, initial 5 to 6 years, it was decent revenue growth and limited EBIT and PAT growth. Not as good as revenue, to be honest. But in from FY17 to FY20, it has not been. I mean, it has been inconsistent at best. CFO greater than PAT in only 4 out of last 10 years, but cumulative CFO is greater than cumulative PAT, right? Cash flow from investments includes asset reinvestments. Non-current assets are up 3.8x, and investment income. So this is very important, right? Because it the investment income is quite significant portion of the cash flow from investing activities, and it it is so significant that it is able to contribute a large part of the asset reinvestments. And CFF is largely dividend payments. Equity is where it was 10 years back, right? So this is slightly unusual for you to notice about a company. Non-current liabilities, majorly provisions, are up 2.6x. So this is why the financial leverage looks so magnified despite a lot of borrowings. Return on capital greater than 15% in 8 out of last 10 years. return on equity greater than 30% in all of last 10 years, right? So return on capital majorly being driven in the earlier years by good margins, return on equity in all the years majorly being driven by the financial leverage positions. EBIT and PAT margins have broadly been maintained, right? This is what we saw, but quite a bit of volatility during these FY16 to FY18 years, right, where it went down quite sharply. Good asset utilization, decent asset utilization, capital turnover greater than 1x in 9 out of last 10 years, and when it was less than 1x, it was very, very close as well, right? Asset turnover greater than 0.75x in 6 out of last 10 years. In the last 3 years, the revenue hasn't been as where it could have been if the growth had continued. So that is why, asset turnover could look slightly lower. Financial leverage has continuously increased, right? The which is being measured by the two measures that we have here: the asset by equity and non-current liabilities by equity, right? Which is both of them have kept on increasing. But company doesn't have a lot of borrowings. There are short-term borrowings, but they're not significant long-term borrowings, right? Most of it, as we've already discussed, are provisions. So what's the conclusion here? Now, I am trying to make sense of all of this performance because everything seems to be going in different directions. What I was able to understand at best is that it has a mixed financial performance, so to speak, right? Mixed financial performance of position as well, because provisions is also something that we have to understand, right? What really is inside the provision, because it is a discretionary item. It requires a lot of judgment on the management and part as well, right? But the company is struggling for consistency, right? Even with respect to whether it's respect to growth, whether it's respect to margins, right? Although the consistent thing has been asset utilization, but with respect to the growth, revenue growth, and also with respect to the margins, the EBIT and PAT margins, it's struggling for consistency. The two things that really highlight for me, I mean, that come out if you could really want to look into the company deeper, are the dividends and the cash position, right? So the company's consistently paying out large amounts of dividend, and the company still has a lot of cash, right? So this is something that you can look at deeper if you're figuring out whether you want to look at this company from an investment standpoint or not, right? But based on this, it is difficult to make a decision. I think if you're looking to if you want to look at this company, then you would have to go in deeper to understand what's really happening. So that is all that I had to share about this company. It will be interesting to see the future of this company as well, because a lot of stress is now going towards the renewable sources of energy. Coal, as we know, is not renewable. It gets exhausted, right? Although it has been the primary source for energy and still is the primary source of energy. So the transition from sources such as coal to something like renewable sources of energy, solar or wind or whatever different sources we have, this is something that remains to be seen. A lot of stress is moving towards that side, but how it materializes, the feasibility of all those new sources, this is something that really remains to be seen. So that is all that I had to share about this company. I hope you were able to understand the mixed financial performance and you could take away a few new things that you could probably apply in context of other companies as well. If you found this helpful, then please share it. If you have any questions, then drop in the comments. And if you want to receive this and much more, then you can subscribe, and you can also sign up to receive these updates directly on your WhatsApp. Thank you so much for watching, and I'll see you again with another company.